All right, welcome back. In case you're just joining us, it's still Moneyline with Nancy on the COVID-19 watch. Joining me right now is my guest. He's Dr. Hassan Mahmud, who is the Director of Monetary Policy Department at the CBN. It's another Wednesday, another CBN weekly segment. Dr. Mahmud, good to have you here in the studio joining us. How are you today?
Fine, good. Thank you for having me.
Okay, let's go straight to business. A lot of takeaways from the MPC meeting on Monday. It happened to be a one-day meeting. Perhaps it's understandable because of the times yes, that we are in right now. The markets did expect that at least the parameters will be unchanged, or let me say for interest rate, for MPR. Why did the MPC decide to hold the benchmark interest rate after dropping it in at the main meeting? Yes.
Yeah. Thank you very much. Several reasons. Fundamentally, the MPC members appraised the global economy as well as the domestic economy in coming to terms with what direction will monetary policy take. Yes, we are aware that there are uncertainties from the global economy due to the COVID-19 that you just mentioned, and how the slowdown or lockdown of economies or stoppages of supply chain, stoppages of trade, tourism, all that affected global effective demand and supply, and how that trickled down to the domestic economy. In-house, we also see that domestically, inflation ticking up by about 10 basis points, even though marginal. We saw pressures at the foreign exchange market. However, there has also been huge stimulus packages, huge injections into the economy, both from the monetary and fiscal authorities, which have their own monetary implications. And don't also forget that the absorptive capacity of the economy to sink in these funds also takes time. So invariably, the members looked at, I'm not a member, but I was privy to the analysis that went into that, looked at this volume of liquidity in the system, looked at the fact that they've reduced MPR by 100 basis points in the previous meeting in July. In May, sorry. And then see how will this sink in to propel this aggregate demand, pushing supply from the other side, and see how the economy grows. So it was just paramount to agree on the fact that let's see how this sinks in, and then we can now take the next move. However, I can also say that even in the MPC, there are members that also voted for cutting rate further, and the governor said it at the communique briefing.
So perhaps the MPC is just taking a wait-and-see mode. Is it that wait-and-see approach? Is it because the MPR was dropped to 12.5% to see how it will crystallize?
Yeah. You see, the MPC is the only tool, monetary policy tool, is not the MPR. There are other factors which are also within the purview of the central bank that they need to follow in terms of managing liquidity, in terms of managing credit growth to the SMEs and to the micro and small enterprises, to the health sector. There are a lot of interventions that the central bank does also to stimulate the output growth from the domestic side. So those other factors are also being weighed in to see, because there should be a consolidation. MPR is more or less a signaling tool, which has been expressed severally. There are other tools that the central bank uses to monitor aggregates, and that is our target in the economy, such that you achieve your mandate of price stability conducive for growth. So those other factors also play a role, including the stimulus packages that I mentioned.
If we take a look at what is really facing us right now, where did the MPC, or where is the MPC thinking that we have more risk? Is it from the global economy or even domestic economy? Because even in the communique or whenever the governor is addressing the press and telling us what the decisions are, the MPC definitely takes a look at some of these parameters. But where are we having the most hits? Take a look at what's happening globally. Coronavirus cases are still increasing. Oil price is still down. What else again? We're seeing also stimulus from global central banks. The EU yesterday, I think, moved for 750 billion euros deal. So similarly to China, US is on one side. Brexit is not yet concluded. Domestic side, we have inflation. We have a not too diversified economy. We have supply chain, quite a whole lot of. So which one is really hitting us?
From my own perspective, most of the shocks that we are having that are distorting macroeconomic fundamentals here are mostly exogenous. They're external. Oil price was a big one. And you know how that fits into government revenue, the ability of government to also meet with its domestic responsibilities, how that hits the exchange rate market because of the demand pressure that will be coming in, activities that happen in those advanced economies, the carry trade, the capital flow reversals, all those hit on our system. You know there's a very strong pass-through from exchange rate to domestic prices, and then you also see what's going on in our balance of payment position now. Because export has shrunk significantly, even though we have some minimal import, that balance of payment deficit are also external shocks that will hit on our balance of on our external reserve. So the shocks are more from the exogenous fundamentals, and that is why it has always been emphasized that we should start looking inwards. We should raise our finances domestically, we should empower the domestic economy, particularly driving this aggregate demand. And that's why the largest employers of labor are the SMEs and the small enterprises. That's why a lot of efforts are going into that, so that those, by the time people are employed, disposable income builds up, and that is the effective demand we need to drive the supply. Because if the people to buy are not there, or they don't have the money to buy, even if you supply, it's going to be sitting there. So those companies need to survive. So that external shocks are very important. But domestically too, we need to also consolidate on the activities of both fiscal and monetary authorities, so as to advance these projections that we have for growth reversing to its positive trend.
Hello YouTubers, welcome to Moneyline with Nancy TV YouTube channel. This is where we provide you with instructive business directions, processes and guidance to help you assess the right resources to fund your businesses to withstand every form of internal and external shock. You will find here awesome informative videos on business, entrepreneurship and lifestyle, just to help you make informed business and financial decisions. Punch the subscribe button and let us drive you through the world of business. Please follow all our social media platforms on Facebook, on Twitter, on Instagram, on LinkedIn, and follow us for latest updates on our website. It seems that the MPC really went for the priority was more of economic growth than targeting inflation, despite an uptick in inflation for the month of June to 12.56% as released by the National Bureau of Statistics. Also by the side, we've also seen PMI, Purchasing Managers Index, declining. So why didn't the MPC also take a look at that? Or is the time is not yet ripe?
Okay, if you look at the statistics, and I'm not sure if you have the details, because what the trend is reversing or is changing in June 2020, because for the Nigerian economy, we actually started lockdown in March. For the advanced economy, they started early January, late December, the China side. So we saw negative growth in their first quarter. For Nigeria, we had 1.8%, which was still positive, even though it was down from 2.55 or 2.2 for 2019. So where we'll see major impact is in the second quarter. However, we're also having projections that if these activities that are going on now, the injections that are going into the economy, are consolidated such that we start seeing the impact by the third quarter, then fourth quarter may nil out or maybe turn positive, or first quarter of 2021. So the shocks is not necessarily coming. The central bank is not only looking at inflation, which is its primary responsibility, but it's also looking at how are we able to drive this domestic demand that will enable you to, because you see, if you look at the inflation CPI, the driver is food inflation. Food is not is something that is also affected by other factors, rainfall, flood, or whatever. However, we've created rooms where access to fund to do agricultural, the agri-intervention programs that we did, so that the farmers can have access to these funds and do but other disasters can also come in and disrupt that. So long as we don't have control over that, what we need to do is to ensure that the prices, are in such a low and stable level that investment plans can take place.
How much of the structural factors would influence the MPC's decision moving forward and perhaps have influenced it, that we've not seen so much move? Structural factors, even the MPC noted it in its communique, structural factors like even the herder-farmer clashes that would also affect our food supply, kidnapping, criminal activities, not even just banditry, because I think banditry is just making that thing so common. It is criminal, terrorism, we're also seeing kidnapping, security challenges, transportation supply, infrastructure, power supply, and all of that. How much of this legacy structural factors, just like the MPC did put it in its communique, would affect the decisions?
A lot of them, and fundamentally that is why we see CBN going into these what people call quasi-physical activities to stimulate growth from the supply side, to stimulate exports, to get foreign exchange earning. Infrastructural issues, power issues, security challenges. Even if you give credit, farmers produce and there are kidnappers on the road or there are Boko Harams, those things are kept in their places, no good storage facilities, they waste, so they don't get to the market. So those structural issues that are outside the purview of the central bank, but don't forget that central bank is also part of Nigeria. So it is important that there's this synergy between both authorities, such that we are able to curtail these structural fundamentals that, like you said, are legacy issues. But we are coming out of it gradually with time. We are seeing that. We are seeing improvement in the agricultural sector. Formerly, banks don't even lend to the agricultural sector. Now, central bank create a window to de-risk that sector and also create interventions to boost that sector. And we see what's happening in rice, maize, and other commodities in that sector.
The CBN or the MPC decided to leave liquidity ratio at 30%. Analysts have also said perhaps that the challenge of holding the CRR at 27.5% and liquidity ratios at 30% at high levels is that perhaps it would also constrain bank access, to liquidity. Just explain to my viewers what that is, because some analysts will say, okay, even if you're going to leave or don't even leave MPR at 12.5%, you can increase it because that's an anchor rate, and perhaps the market does not even respond so well to it. Where the market will respond to is the cash reserve requirement.
What we're looking at in terms of that, if you look at the numbers that were also reeled out during the MPC, we still see cases of excess liquidity in the banking sector. And we saw some banks that did not meet the 65% threshold of LDR that were charged. So if you have this excess liquidity and you're not lending, why will you not be lending? We understand that, there are risk factors that banks will also look at in doing their lending analysis. However, we're also looking at the fact that the banks are seeing an alternative window, which is not necessarily going to add to our growth projections that we are looking at. That is investing in government bills, so because treasury bills are risk-free, even though it is low. But at least if you look at the risk factor and the cost of managing those facilities, the banks will prefer to do that or do their trading in FX. So we need to, even though adding to the moral suasion that we're doing, we need to have some regulatory guidelines that banks must lend, because that is their initial, that is their mandate in the first place, intermediation. And so the banks need to develop skills to analyze those risks and invest in those activities. So while we are looking at the CRR, drawing more money in the analysis, also that we have almost about 10 trillion in the CRR bucket that is being held, and so banks should deploy those funds to lend. And if you complain that, okay, because you don't understand the risk of the factor, get the expert to diagnose those risks and invest in those sectors, so that you also contribute to growth in the economy.
What is the MPC most targeted on as we are in a period whereby the pandemic is worsening our economic situation? It's really a tough one out there. A lot of Nigerians are out of jobs. Some, of course, our unemployment rate, the last data we have, 23.1%. The Vice President said it himself that about 39.4 million people will lose their jobs this year. So what is the MPC looking forward to? Because I think you have about 2 meetings till the end of...
we have another one in September.
Yes, 2 meetings this year.
Another one
in November.
Yes, Number one, the monetary policy framework, as it's been used now, use monetary aggregate as its target, operational target. That means the volume of money in the system, money supply, M3. So we looked at, does the money in the system commensurate with the economic activities? If it doesn't meet that economic activity, then the money will become excess. And the central bank will have to pull those money out of the system so that inflationary pressures do not build up because of that excess liquidity in the system. So we looked at that. But our ultimate target is also economic growth. And then we also look at exchange rates. And then look at the interest rate in the domestic economy such that, you know, when we are talking of LDR, expanding credit to the private sector, how affordable is that credit? And this crisis brought in a situation where even the central bank had to adjust its intervention fund interest rate downwards. The banks are allowed to restructure forbearances, to restructure some of these facilities because of the shocks coming in from that. So we're looking at that bucket itself. However, we'll also be looking at a situation, and that's why I said the absorptive capacity of the economies is very, very important. You don't just pump, because the supply side is more rigid than the demand side. So if you give all these people, everybody money, you know, palliatives and social interventions and all the credit, but the supply is not coming up. So everybody is going to the market to buy while the supply is not meeting up. So then you start seeing excess demand, driving demand pull inflation coming on board. So we need to also push, give incentives to the supply side so that it will come out, there will be an equilibrium, so that you get to a level that the price is stable enough to drive the, you know, to drive the growth threshold that we are looking at.
How much is the exchange rate conversation in all of this? Because, you know, I think just a few weeks ago, the CBN also adjusted the FX rate. Though a lot of people said, oh, the country, the CBN devalued, the CBN devalued. The Apex Bank said, we just adjusted. And you heard when the governor did say it at the MPC, about 380 to 390. Now, how much of this FX rate is conversation is going on? Because these are what the foreign investors are also taking a look at. Even those we do businesses with, like the IMF, the World Bank, you know.
Like I said in the beginning, the exchange rate is extremely critical in also stabilizing the domestic economy. The economists will say Nigeria is a small open economy. That means it's exposed to external shocks. And if you look at the portfolio of the inflows, the foreign portfolio inflows that comes into the economy, which is deepening our capital market and, you know, providing finances for other activities. So it's not in itself bad per se, but we need to monitor that the inflows, we prefer more of direct foreign investment, which will stay in the economy, build factories and employ people, than those that will trade in FX. So, however, if they're already in, and you need to, you know, control how they move out in a disorderly manner, because that will bring a lot of pressure on the FX. If something happened in the United States now, like this normalization that is going on now, the investors, if they have, you know, safer investment windows out there, will come and pull out their dollars from here. When everybody coming, if you assume like we have our 10 billion portfolio investments coming in to hit our 36 billion reserve position, don't forget that the reserve is now the tool that central bank have to, you know, defend the naira, and that's why we monetize and give federal and then hold that as a tool to defend the naira. But there's a proportion where, when threshold where we get to, even the foreign investor will start, you know, getting jittery. So we need to maintain that reserve level. But the COVID-19 issue and the oil price shock that came in shrunk the supply side of it. You know, the inflows shrunk significantly, even through the federal, the government inflows from oil receipt. But the demand did not go down in the same commensurate proportion. So, and even governor had to go to, you know, publicly to mention that we can meet our demand requests now, but it has to be in an orderly manner, because there's a crisis. All of you cannot just come at the same time. So that, you know, sustaining that confidence for the foreign investor that this can happen. And you don't sustain it with more word of mouth. You sustain it with your statistics. What is happening with your balance of payment, what's happening with your external reserves, and what is happening with the volatility of exchange rate in your FX market. So, like I said, we cannot hold the rate that this is the rate that is going to run the market. The forces of demand and supply, we do that. But also be sure that we don't bring, you know, like outlier events, you know, spikes that will really distort the market because of maybe speculators or other things like that. It should reflect the fundamentals of trade. FX demand should be backed by certain economic activities that will come and impact on the domestic economy. So it's a very, and that's why I said we also target exchange rates and see how the rate. Our paramount objective is to make sure that the exchange rate market is stable, it's transparent, and deep enough that you can raise whatever resources you want to raise. It's liquid. Yeah.
Is the central bank, of course, central bank, because some of the members of the MPC too are central bank officials. Is the central bank, the Nigerian central bank, watching also what other central banks are doing globally, and perhaps how it would affect us? Like I said earlier, the EU leaders agreed on a deal of about $875 billion. That's, I'm dollarizing that by, I think, about 750 billion euros. Yeah. The US is also on the verge of another one. I think a new deal might just be done in August. The parliament's there. You're also seeing pockets of global central banks and also global leaders saying our economies are not moving as fast as we would do. The UK also approved the deal. UK Prime Minister Boris Johnson. So how is the Central Bank of Nigeria gauging all of this? Because all of this will definitely affect us
Definitely, yes. The monetary injections will affect us. The quantitative easing that is going on in those economies will significantly affect us and also affect the global liquidity position. Also remember that activities in the global financial system, particularly the securities and the exchanges overseas, the London Stock Exchange, the Johannesburg Exchange, the New York Exchange, activities there feed into our own domestic market because we have foreign investors in the domestic market. So we are watching that even within the African continent. We definitely have some rival economies because all of us want to attract these foreign inflows because we have financing gap domestically. So you need to have that, economic parameters and financial parameters to make the investors have enough confidence in bringing these inflows because we need banks raise euro bonds and stuff like that. They also look at this when the Fitch and Poor credit rating agencies come in, they look at how are the inflows coming in, and that's why we'll be saying that let us diversify this source of inflows, particularly the foreign exchange, through export, not necessarily only oil export, non-oil exports. Now we had this gold project that we're doing that is another, channel of getting in, enhancing our external reserve by buying the gold in Naira because we already have the Naira here. By buying the gold in Naira and creating jobs for a lot of artisan miners. So that diversification is very important. It's ongoing. It's not something that we are seeing now that the non-oil sector is driving more of growth now. The proportion of oil in the contribution of GDP is reducing less than 10%, 7%, 8%. However, its contribution to revenue is still in the ranges of 70, 80, 90%. That's what we want to diversify, and that's why you see Central Bank also doing this export stimulating funds and all these power sector funds so that all these, structural issues that you mentioned can be taken away such that the flow of how effective demand and supply will work to drive growth is achieved. That diversification is fundamental. Even if it's not vertical, even if you can do horizontal diversification, even within the oil industry. We don't have to, there are other value chain that you can also create within the oil industry, the fertilizer, the plastic companies and stuff like that. Even if you can do that horizontal diversification, it will still build, on that instead. And then the volatility, if you do the fertilizers, the plastic, they are consumed domestically. So the market is here. You don't have to be looking at what is the price of fertilizer in somewhere else when you are producing it here, using local inputs already. So I think that diversification is very, very important for us to, safeguard against these shocks. And then looking inwards. Part
of the diversification would also be having good infrastructure that will lead that. I don't know if you can answer this question because the governor also answered it. He spoke about the Infraco. PLC, 15 trillion naira. I remember at the round table that was done at the CBN headquarters, I think in February, March. In March, when Aliko Dangote is like all the big titans were there, and that come into fruition. Can you just speak about it and, just a bit?
The fundamental thing is that the government, is obvious now, does not have the funds to finance our infrastructural deficits. And the government cannot be borrowing in perpetuity because we will pay back the debt. Now, why? And then that issue which has been existing, this PPP, bring in the private sector to invest in this and, let them take off some of the risk and bring in their own capital, even if it's going to be foreign capital, to come into this. And we've seen some of those concessionary, infrastructure development by China and other, economies. So the infraco is where central bank comes in, take off some of this funding load off the government, like the Lagos-Ibadan Expressway now, assuming that road is a 1 trillion naira road. The government has spent maybe 300 billion naira. Give back the government is 300 billion naira. Go and be looking at healthcare, go and be looking at education, go and be looking at other this thing. Central bank creates a vehicle where investors come in. The credibility issue is there. The firepower of the fund is there. And then these investors come in, bring in their money. You toll those roads, or you find other sources. Okay, even if it's to build and operate and then return back to, and transfer. Or you do it and then you recoup your money over 15 years, over 20 years. But that capital has come in and it has offloaded the government, the pressure of looking for that money. While other recurrent activities are suffering, people are losing their jobs. So face, the basic utilities of the economy, and this big bucket, investment vehicles, we bring in foreign investors, and that is the main, strategy of that. And if that is implemented, it will significant, because look at Dangote refinery. I'm sure you have spent over 50 billion in that project. If it is government, I'm sure it's going to reach 2027 or something, because they'll be going according to how they get the money. And I'm sure the Dangote has also borrowed, but it was is borrowing on his own integrity as a private investor, and people are looking at his capital base and all the stuff like that. So if you have people that will come into power like that, bring in their investment and everything and go into power. I remember they were talking with GE sometimes back. We've seen what we are having with the transmission
Siemens
company and stuff like that. So if you bring, and we must do these things very transparent, and we have to have, committed investors. It's not just people that have, political backing and just want to get the license and resell. No, there must be due diligence and checking that you have the technical capability and you also have the capital to do it. If you don't have the capital, you have a capital source that can back that. So if we're able to do that diligently, the power sector is taking almost 16, 20 years, and we're still doing how many megawatts up till today. By the time you bring in people, and that's the pricing issue is also there. We've seen how, when the power, wherever MTOs wanted to raise tariffs and stuff like that, we see the resistance. But they are genuine resistance, because if you don't get the power, what are you paying for? We had issues with the discos, given estimated billions, and when the initial condition is for you to bring in this infrastructure, bring the meters and everything. And that's why Fashola said one time, if they don't give you a meter over a particular period, don't pay the bill. Because you have to bring in your own capital. You just don't call in people to be paying you money. So those regulatory, platform, legal, and framework should be very sound and very, very credible, such that investors will have the confidence to come in. Because even though you are providing the money, you also need to look at all those legal framework to see that if there's a dispute, there's a transparent way where that can be resolved, and their resources will not just go like we used to have in the past, where government just nationalized foreign investments, and then the people just go like that. We've gone beyond that stage now.
Okay, I think Dr. Mahmud will leave it at that. We'll see you all again, God willing, by September. Yes, September meeting. Thank you very much.
Thank you very much.
Thank you for watching our video. Please hit the subscribe button below, turn on post notification to follow all our updates.